In the crypto world, fortunes can be made in the blink of an eye, and they can vanish just as quickly. We've just seen one of the most staggering downturns in Bitcoin's history. So in this explainer, we're going to break down exactly what happened, why it happened, and most importantly, why it matters to all of us.
Let's just start with the headline number because it is pretty shocking. Since its all-time high just a few months ago, Bitcoin has lost half of its value, a 50% drop. That's a move that sent some serious shockwaves through the entire financial world.
And look, this isn't just about one digital currency. This massive price collapse has effectively wiped out an estimated $2 trillion from the global crypto market. That is a huge amount of value, and it affects everyone from individual investors all the way up to major corporations. So the big question on everyone's mind is, how did we get here? This didn't just happen overnight. It was a rapid cool down that really caught a lot of people by surprise, and it all started just a few short months ago.
It's wild when you look at the timeline. The absolute peak was back in October 2025, when Bitcoin smashed records, hitting over $126,000. But by December, you could see the price was starting to slip. Then, come January 2026, the sell-off really picked up steam, and it all culminated in February when the price just plunged to around $63,000. So what on earth caused such a dramatic reversal? Well, it wasn't just one single thing. It was more like a perfect storm of different factors that all came together at exactly the same time. So what exactly pushed the price off this cliff? Well, after digging into it, it really seems to come down to three key drivers. We can kind of group the causes into three main buckets. First, pressures coming from within the crypto market itself. Second, these major shifts happening in the wider economy. And third, some new headwinds from policymakers and big institutions. Okay, so first up, let's talk about those internal pressures. A really big factor was just simple profit-taking. You had a lot of early investors, people who had been holding Bitcoin for years, who saw these record-high prices and thought, you know what, this is the perfect time to cash out and lock in these enormous gains. Michael Novogratz from Galaxy Digital even gave it a name, OG profit-taking, and he confirmed that the scale of the sell-off by those original long-term investors was actually way bigger than a lot of analysts had been expecting. Now, the second internal pressure came from the big players, the institutional investors. The Bitcoin ETFs, which had been this huge pipeline for new money flowing into the market, suddenly started seeing major withdrawals. And that was a really clear signal that institutional confidence was starting to crack. You can see that shift plain as day right here on this chart. The fire hose of money flowing into Bitcoin ETFs in late 2025 slows to a trickle and then completely reverses into significant outflows by early 2026. The institutional bull run, as some were calling it, was fading and fast. Okay, so now let's zoom out from just crypto, because there was a much bigger change happening in how investors felt about the global economy. We entered what's called a risk-off environment. Basically, investors started getting really nervous, and they began selling their high-risk, high-reward assets, things like tech stocks and, yes, crypto, to move their money into safer, more stable investments. Analyst Jim Bianco really captured the mood perfectly here. The old story that was driving prices up, this idea of widespread adoption, it just wasn't working anymore. A new narrative was needed, and as he puts it, until one emerges, winter continues. Now, on the policy front, there's a key term we need to understand, and that's hawkish. When you hear that, think of a monetary policy that favors higher interest rates to fight inflation. And when interest rates go up, it makes speculative assets like Bitcoin seem a lot less appealing compared to safer options that are now paying you more. And that is exactly what the market started to get scared of. The nomination of Kevin Warsh, who is seen as a hawk to be the new Fed chair, really spooked investors. And that was made even worse by a statement from the U.S. Treasury Secretary, who basically made it clear there would be no government safety net to bail out crypto, which just added to the perceived risk. Okay, so let's shift gears from the causes of the crash to its consequences. Who is actually being impacted by this massive drop in price? Well, the pain was felt almost immediately by companies that had bet big on Bitcoin. Firms that had woven Bitcoin into their corporate strategy or their business models were hit especially hard. Two of the most prominent examples are the crypto exchange Gemini and the software company Strategy, which you might remember as MicroStrategy. For Gemini, it meant announcing they were laying off a quarter of their staff. Meanwhile, Strategy, which is one of the biggest corporate buyers of Bitcoin out there, saw its stock plummet. Its average purchase price for all the Bitcoin it holds is now around $76,000, which is well above the current market price. That means its massive crypto bet is currently underwater.
But not everyone is hitting the panic button. Michael Saylor, the head of strategy, remains famously bullish. He tweeted that volatility is a gift to the faithful, basically framing this whole crash as a test of conviction and an opportunity for the true long-term believers. And then, on the complete other end of the spectrum, you have this view from a leader at Vanguard, a giant in the world of traditional finance. His comment just highlights the fundamental uncertainty that still surrounds Bitcoin's true value. I mean, is it a revolutionary new asset, or is it a speculative bubble? The experts are clearly and deeply divided.
To really get why there's such a huge divide, it helps to just step back and look at the hard data. Let's put Bitcoin's performance into context as a financial asset. If you look at this comparative analysis from 2020 to 2024, it's pretty stunning. Bitcoin offered an average monthly return of over 6%, which just dwarfs traditional investments like the S&P 500. But then you look at the volatility column, and whoa, Bitcoin's risk was nearly 4 times higher. This is the classic high-risk, high-return trade-off in its most extreme form.
Okay, so after digging through all of that, let's take a moment and summarize what we actually know for sure versus what's still really up in the air.
So here are the confirmed facts. The price is down 50%. Trillions in value have been wiped from the market. Companies are feeling real pain, and it's all happening in the middle of a global flight from risk. But the uncertainties are just as important. We just don't know how long this crypto winter will last, what the future holds for institutional investment, or if some new compelling story will pop up to reignite the market.
And all of this leaves us with a final, much broader question that really goes beyond just Bitcoin. As volatility seems to become the new normal in our financial world, an event like this forces all of us to think about a really fundamental challenge. How do we balance that powerful hunt for high-risk, high-return assets with the essential need for long-term financial stability?